Good afternoon, everybody. Thanks for being with us today. We're going to go ahead and get started in just a moment, so just bear with us.
Good afternoon, everyone. Jerett, can you hear me there?
I can hear you.
All right. Well, welcome, everyone. Thanks for joining us today on our estate planning webinar call. I know many of you have joined us for our weekly calls with Cliff Hodge and myself regarding the markets, the investment process, et cetera. So we appreciate you joining for more of a planning topic today. So first, I'm going to introduce Jerett DiMarzio, who is one of our certified financial planner, wealth advisor with the Cornerstone team. So Jerett, thanks for joining us today.
Yeah. Hi, how are you?
Man of few words. Thank you, Jerett.
I feel, sheltered in place here. Not getting a lot of interaction, right?
Exactly. Well, I'm sure, Jerett, that you've been talking to clients or doing Zoom meetings, the topic of, should I redo or relook at my estate plan, my will, et cetera. So I thought this was a timely call given the environment that we're in, being able to shelter in place and take a good look at what's going on. So the webinar today was a good start to a planning topic for us. One thing I do want to remind everybody is that we do have you on mute. However, if you have a question, you can certainly go and ask a question, and we'll take some questions at the end of the session today. So thanks for doing that. As we begin, first thing I want to kind of start with in terms of estate planning, and just a reminder, there's a difference between estate planning and estate tax planning. So when Jerett and I, when we talk to our clients about estate planning is how do you pass your assets on in the most efficient manner with the least amount of cost. And when I say cost, I typically mean probate cost, and that's the cost to actually transfer assets. So it's how do you do that in the most efficient manner to the ones you love and want the assets to go to. When we change to the discussion of estate tax planning, the topic is really about how do we limit the cost that we're using, or that the cost to pass on those assets. And the current estate tax levels, we're able to pass on as a couple, if you're married, about $23 million. So there's a fair amount of assets that can pass, but we're going to kind of talk through some of those strategies today. But that's where, when we start talking about estate tax planning, it's when we have larger estates and there's different techniques that we would put in place. So as we start today, first slide you see here is kind of some estate tax reduction strategies. The first one is kind of what I've already been talking about, and that's the federal tax exemption. And the federal tax exemption is that each individual has 11,580,000 that could be passed on to heirs, spouse, whoever. That's, again, individual. As a couple, we have over $23 million that can be passed. So the federal exemption is $11.5 million per person. That federal exemption also carries over because it used to be at your death you would pass those assets on, but it is also, we are able to give a lifetime gift of that same $11.5 million while we're living to anybody. So that could be while living or at death. Another strategy or technique that people are probably familiar with is the annual exclusion. And this is where each person, every individual can give to anybody, family, friends, whoever you wish, $15,000 per year. So if you're married, you can give 15, your spouse can give 15. Again, that could be children, grandchildren, whoever. We're able to use, there's no tax, gift tax issues that we have to worry about. There's no tax filings. We can give that amount out. Other things, just a quick difference. There's income taxes. Income taxes is what we pay every year, typically every April 15th. However, 2020 has not been a normal year, so we say that has been transferred to July 15th of 2020. So income taxes are when we earned income, interest, dividends, anything we receive that we have to pay taxes on, capital gains, etc. Those dollars we pay on a yearly basis. For estate taxes, that is upon a gift or when we pass and deceased, we will then have to, or our estate could pay estate taxes. That, again, anything above that $23 million as a couple would be assessed a 40% tax rate. So again, the state tax planning is trying to reduce that liability. And the last is very similar to the exemption and lifetime gifts. You can use a credit shelter trust where you move money, again, while living or at death into this shelter trust that could then grow and could grow on a tax-free basis depending upon how it's set up. So there's different strategies we can certainly talk with our clients about. So if we go to if we move to the next slide, Jerett, why don't you start off by talking about the 4 documents everyone should really have.
Yeah, so this very common documents I'm sure everyone's heard of. You have your will, potentially a trust, durable power of attorney, healthcare power of attorney, maybe even a living will, a little bit different. So will is really the catch-all. It's it's at the bottom of the funnel. It's what typically you use to pass tangible assets. It's not preferred method to pass your liquid assets, but it may if you don't do some of the other things that we're going to discuss correctly. Trust is a document that allows you to dictate and control assets beyond your grave. You can be very specific in your language inside of a trust. It's, common misconception is a trust is only for very, very, very wealthy people. That's just simply not the case. If you want to be very specific with how your assets transfer, a trust is a highly recommended document. Durable power of attorney is it's a power of attorney that you can use in all situations. So typically durable power of attorney is for financial things that you're going to be doing. So let's say, for example, your spouse is incapacitated. You want a durable power of attorney to be able to act on their behalf. And then of course, a healthcare power of attorney is pretty self-explanatory. That's something that you're going to use for someone to make healthcare decisions.
Thanks, Jerett. So why don't we if we look at the start of our slide. So today we're going to talk about how assets transfers, and those that are on the line may have heard me talk about this before, but assets basically transfer 4 simple ways. The first is how you own an asset. The second is is there a beneficiary attachment to that asset? If it's owned by a trust, and a trust, if everybody is not familiar, a trust is private, meaning that no one has access or knows what's going on except the trustee and the beneficiaries if they're given the knowledge. And then the last place of and I say it's the last place because when we pass on assets, all these other, ownership, beneficiary, trust, we look at those first, and then we look if it's not owned jointly, if it's not in a beneficiary attachment, if it's not owned by a trust, the will then decides how that assets will be transferred. And then with a will, sometimes we hear the I love you wills, which is everything goes to my spouse and then to my children equally. So there's different, the AB will, there's different type of wills that we've heard, but a will kind of encapsulates and captures everything. So if let's start off, Jerett, by you talking and telling us a little bit about how assets are owned and how they could be owned.
Yeah, thanks, Jeff. So when you think about how assets are owned, one of the most common assets that we all have now is an IRA, perhaps a 401k, rollover IRA that used to be a 401k. So those are all retirement assets that are held individually. That's an individual retirement account, or a Roth IRA, for example, is a Roth individual retirement account. Those are held individually, and you have a beneficiary designation. Typically your spouse, your children, someone else as a beneficiary. So that's the person who's going to inherit that account if you pass. Well, an individual brokerage account, for example, doesn't necessarily have to have, and Jeff mentioned something earlier when we were talking, is we see transfers come in from other brokerage firms that don't have beneficiary designations on after-tax accounts. So you may have seen this, your accounts at Cornerstone, TOD. Well, what does that mean? Transfer on death. So it can be a TOD on an individual brokerage account. You can actually add a TOD on your joint account. So joint account can be joint tenants in common, or it can be joint tenants with rights of survivorship. You've seen these designations on your Fidelity or Schwab accounts. Well, you can actually add a TOD designation on the joint account. So basically that's going to allow you to pass the assets. Let's say you and your joint account owner, you and your spouse both go on a trip, don't come back, unfortunately, and that TOD designation directs the custodian to pass the assets to the beneficiary. We'll give you a really inexpensive estate planning tip here that you probably haven't heard. Hopefully you have from us. A POD beneficiary designation is payable upon death, and that's for your bank account. So if you have a joint account at the bank, we recommend that you double check to make sure you have POD, perhaps to your children or other beneficiaries, just in case something happens to both you and the joint account owner, so that that account does not have to go through probate. So when you think about your non-qualified accounts, your non-qualified investments are bank accounts, your brokerage accounts, even real estate. So we have some information on this slide that explains, long-term capital gains rates, short-term capital gains rates, ordinary income, how dividends are received, and how these different accounts are taxed. We're all very familiar with that. But one thing that you may have heard, maybe not, is that these accounts are eligible for what's called a StepUp in basis. So if you're a joint account owner and your spouse passes and you bought Apple stock for $50 a share years ago, congratulations, first of all, but your spouse is going to be very happy that there's still a StepUp in basis on that account. So your basis is the cost per share of what you paid for that stock. Well, at death, up to 6 months after death, you can elect the StepUp in basis to fair market value. So basically what that means is if Apple is trading at $200 a share, the new basis is $200, which obviously limits the taxable gain if you sold it. So that's a very important thing to know for non-qualified investment accounts.
So before we kind of go into non-qualified, or I'm sorry, the qualified assets, so Jerett, again, the ownership of assets, and I know the advisors, myself, and we've seen accounts come from banks, wirehouses come over and they're owned individually or even they're owned jointly, so they would pass, but they don't have that transfer on death, that payable on death, additional documentation. Why that's so important, and I'm sitting in the office here in North Carolina. I'm going to use North Carolina as our probate state. So in North Carolina, the probatable, if anything goes through probate, it's about $4 per thousand to go through the court system. So I know I've seen a lot of accounts, $1 million+ accounts that have come in without a transfer on death, not owned by the trust, guaranteed to go through probate. That is just caught by not having that one simple document. It's costing $1 million account about $40,000 of costs that don't need to happen, that don't need to really happen. So it's really important to the ownership of and how it's owned, and not only the ownership, how it could pass if you have these simple techniques added on. So we've talked about ownership. So now we're going to change to the type of assets we would own that would have a beneficiary attachment. The first one of our the biggest asset that many people have outside of their homes typically may be their 401k, or if they're retired, it's been rolled over to an IRA. IRA is a qualified investment or qualified asset. Qualified assets put beneficiary attachments on, or a document that can be added on to those investments. You can name a spouse, as you can see, children, heirs, or a trust. I'm going to talk first. If you name your spouse is the only beneficiary and I'll use my wife Shannon and I, if I was to pass, Shannon can take over the IRA as her own. Spouses are only allowed to take over assets from another spouse as their own, and it becomes their retirement account. Versus if I leave it to my children cannot take, so Shannon and Declan and Kira cannot take over the account as their own, but they could take it over as an inherited IRA. What an inherited IRA allows them to do is to spread out the liability of the taxes over a 10-year period of time. And there was some changes last year that prior to 2020, we were able to take money over lifetime using this inherited IRA strategy. However, any money received after 1/1/2020 is now needs to be taken out by year 10. So you can take it a little bit out at year 1, nothing year 2 through 5, take a little bit more, but by the 10th year, it needs to be exhausted. Beneficiary of an IRA can also be a trust, but the important part here of when you name a trust, you need to make sure the language in that trust will accept the IRA assets. There's reasons why you want to make sure. So making sure that the language is specific to accept the IRA. And then we just put here on the bottom of the slide, just a reminder that for 2020, if you have an inherited IRA, if you have an IRA, RMDs, which again stand for required minimum distributions, are not required to come out given the CARES Act and do not need to be dispersed for this year and this year only. When we go to the next slide and we talk about another type of qualified asset, a Roth IRA, if we're familiar that a Roth IRA is a tax-free retirement account, these are dollars that you've already paid on the principal you've paid taxes on, but any interest you earn over time, if you meet criteria 5 years or 59.5, these dollars are totally tax-free. Again, just like in an IRA, a beneficiary can take over an IRA as their own, or as long as it's held over 5 years, that will be distributed over life expectancy, and those dollars are tax-free. A Roth IRA can also be inherited by children or other heirs, but they can use the inherited rules of an inherited Roth IRA, but just like the IRA, those assets have to be dispersed by the 10th year. The only difference is because it's a Roth IRA, there is no tax implications on those dollars. Just the IRS wants those dollars out to get back into the system. Another type of asset that many folks own is life insurance. Life insurance can be a great estate planning tool and if used properly. But when we look at life insurance, we're not only looking at the beneficiary of life insurance, but we're also looking at who owns it. So do I own it? Does my spouse own it? Do my children? Does my trust? Who's the beneficiary? So I could own the life insurance and my children may be the beneficiary. But when I die, since I own it, it's part of my estate. So it's calculated for my estate. There could be estate taxes or there may not be. Life insurance could be received on a tax-free basis outside, but again, there could be a taxable component depending upon one's estate. So when you use life insurance, again, how it's owned and who the beneficiary is very important. So you need to understand and look at the techniques of how and what we can be doing. When we look at the use of other beneficiary type of assets like an annuity, annuities are, again, also investments that are issued by insurance companies, which when you have an insurance company, you have a beneficiary attachment. Annuities, I'm going to use non-qualified annuities as an example here. If you have a non-qualified annuity, we need to be aware that unlike Jerett was mentioning earlier about StepUp and basis on stock, there is no StepUp and basis for annuities. So if you put $100,000 into an annuity and it's now worth $200,000. The $100,000 that you put in is return of principal. That would not be taxable, but the additional gains that were received would be taxed as ordinary income. A spouse could take over that IRA, or a non-spouse could look to take it as a lump sum or a payout over 5 years. So there's different techniques that we would use for non-qualified annuities, and we certainly have further discussion. So we've talked about how assets are owned and how they transfer upon ownership. We've talked about how assets transfer through beneficiary. The third area is how assets transfer via trust. So let's talk about trust, Jerett.
Yeah, so thanks, Jeff. I know you had a lot to cover there. So trusts, like I mentioned earlier, they can be for anyone. It depends on how you want assets to transfer. If you want control over the assets after your death, then trust can certainly help you do that. Many of you have heard of revocable or irrevocable trust. There's two very, very different types of trust. Some common revocable trusts, Jeff mentioned earlier, credit shelter trust. And if you have an estate tax issue at your death, first and foremost, congratulations. That's not an easy thing to do. A credit shelter trust may be something that you already have set up. If not, we can certainly help you and point you in the right direction. Another common revocable trust is called a Q-tip trust. This isn't a bathroom tool. This is actually a trust called a qualified terminable interest property trust. Very common for planning for spousal income with the remainder of the assets passed to children. So imagine perhaps you're in a second marriage and you have children from a first marriage, and so does your spouse. And you've agreed that the income within the trust is going to be for the spouse, but the remainder of the trust after your spouse's death will go to your children. That can be accomplished very, very easily with a Q-tip trust, very common trust. Some irrevocable trusts you may have heard of, an ILIT, an irrevocable life insurance trust. It's often used to hold life insurance that passes outside of the estate. So Jeff mentioned earlier, if you have a death benefit for life insurance at your death, that death benefit is actually added back into your estate calculation. Well, if it's held irrevocably, basically outside of your estate, you can't make changes to this, then that death benefit is outside of your estate, held in this ILIT trust. Sometimes an ILIT trust with life insurance is used to pay estate taxes. Many folks don't have an estate tax issue now. Well, that may change in the future, so it's something to keep in mind. Another thing that an ILIT is used for is some legacy planning. Perhaps you would like to make that gift of $15,000. Well, that $15,000 gift can be a premium payment for a survivorship policy with you and your spouse. Well, that death benefit may be very large, and that may be not for your children because they're very successful, but perhaps your grandchildren. So that can be used as a tool to pass assets. Some other very common irrevocable trust types, charitable remainder trusts. That's income to you now and the remainder to the charity. You get tax benefits for making these donations. Charitable lead trust is something that we don't have on the slide, but that's similar but opposite. So you pay the charity now and the remainder goes to your beneficiaries. Another one is a grantor retained annuity trust. Very common type of trust that's used for, let's say, business owners, for example, or someone who has an asset that hasn't yet appreciated, but they expect it to appreciate to a very high value in the future. It's a way that you can use the GRAT trust, put the asset into the trust, allow it to grow in the trust, and really reduce capital gains taxes in the future. Another very common type of trust is a special needs trust used to take care of someone that you take care of perhaps in the future. Okay.
And I think when you think about trust, again, trust gives you the ability to have some controls while you're, like you mentioned earlier, while you're living, but also at your death. So whether you have amount of how much is going to be paid out, who it's going to be paid to. We've seen trusts all the time where you have, depending upon how old your children are, you may have a portion pay out at 25, 30, 35, you have these controls, what we call control from beyond or beyond the grave. So you can put these stipulations in place to help provide support for, again, younger children, but also spendthrift, whatever it may be, give you some controls. As we kind of go into the last and final area of how assets pass, again, is the will. And again, this is the kind of the catch-all. If we don't have beneficiaries, if you don't have transfer on death, or you don't have it owned by a trust, the will is kind of catches it at the end. Other important parts of the will, again, of course, is the executor or executrix. You could also have, if you have younger children under the age of 18, guardianship provision. Forget about the money. If you have children, it's more important to make sure your children are taken care, and the people that you want your children, if you're not available or not there, making sure that the people that you think would be the best guardians for them are. Rather than going through the courts, you want to be able to choose that. Not an easy task at hand, but guardianship provision, very important. If there's items that are important to pass on, engagement rings, family heirlooms, baseball card collection, whatever it may be, antiques, a letter of instruction of who they should go to and how they should be passed is very important. And then lastly, as I mentioned, anything that goes through the will is a guaranteed probatable asset. So there's cost, and be aware of the cost. So we kind of say the catch-all, the way we try and do our planning is that the will doesn't really, is really not a whole lot going through the will. We want very little to pass through the will. So, but if there's anything we forgot, or you forgot, I see it a lot of times with ownership on cars. Sometimes we individually own it, sometimes we jointly. There's just different things we would use for the will. So, hey, one reminder again, if you have a question, you can on the Zoom meeting here. We had a couple questions come in prior, but if you do have questions, feel free to pop up some questions. We'll take them in just a few minutes here. Jerett, why don't you share with us kind of some 5 key avoidable mistakes that we've learned, and we've learned a lot of lessons from with ourselves and our clients over the years.
Yeah, of course. And, one of the things, Jeff, is I noticed someone had raised their hand, so to speak. Doris, you raised your hand on the Zoom meeting here. Please make sure that you type your question in the Q&A box so that we can make sure that we answer your question. Obviously, we'll give you a call otherwise. But if you have any questions, like Jeff said, make sure they're typed in there, and we'll be happy to answer them for you. All right, so top 5 avoidable estate planning mistakes. Number 1, not planning for possible future incompetency. So, hopes to anyone, you're in a car accident, you're in the hospital, you need access to funds. You have an IRA. As we mentioned earlier, an IRA is an individual retirement account. That is not a joint account. We can only take direction from the account holder. So if that person is not able to request a withdrawal, we can't take instruction from another person. So having a durable power of attorney can certainly help you have access to be able to do that. And, our goal is to provide you with superior service, and thinking of these things in advance is the best way that we can possibly accomplish that. So if you have a monthly distribution set up, of course, that won't stop, but having a durable power of attorney to request a distribution on behalf of someone else, that can be accomplished. Okay. So number 2, not carefully considered how assets are titled. And we've talked about this obviously for the last few minutes, but how your assets are titled is how you own the asset. That's your registration. Obviously, IRA is titled in your name. Is it titled joint? Is it joint with a TOD or POD beneficiary designation? Is it titled in the name of a trust? So be very careful on how assets are titled. Make sure you have your beneficiary designations on your paperwork. Number 3, leaving a trust unfunded. We see this way too often. I know there's some advisors on the call. I'm sure they would definitely agree. A trust is a piece of paper. You may have spent a few $1,000s. It may be perfect, but it's just a piece of paper until we move assets into the trust, basically, which means we re-register the account as the name of the trust, or we use the trust as the beneficiary designation. So some clients I'm thinking of have a family trust, and even the IRAs, the spouse isn't the beneficiary for the after-tax accounts, it's the trust. Perhaps you want the IRA to pass directly to the spouse first, and then at second death, pass into the trust. So that's funding a trust. Very avoidable mistake. Number 4, assets being left outright to beneficiaries. We've definitely covered this. Make sure there's a beneficiary designation on your accounts. As Jeff mentioned, it's the very first place that will be looked for to see who is to be the recipient of this account once you've passed. And number 5, not periodically reviewing your estate plan. So hopefully, we hope that since you joined this little webinar here, that it's something that maybe you did today, maybe you've done it recently, maybe you plan on doing it. We're all sheltered in place, at least for a few more days before we get out and about. One thing that I did recently was pull my estate planning documents out, look them over. Have you moved to another state? Does something need to be updated? Are your children no longer minors? They're listed as minors in your trust, for example. Has someone passed away that was listed as a beneficiary? A common one that we see is, perhaps you were divorced and your ex-spouse is the beneficiary of an account. You may or may not want to change that. My guess is you probably do. So make sure you're reviewing these things. Get your estate plan out. Take a look at it. We recommend that you review your estate plan at least every 3 to 5 years. We would love to put a copy of it in your vault, your e-money vault. The actual document itself is what counts, but we'd love to put a copy of it for reference in your e-money vault. So that's always something that you can upload. We can take a look at it with you during your next planning meeting.
All right, so I know we went over a lot today, but again, we want to make sure, given the times that we're in, it was certainly with shelter in place and being at home, good, as Jerett mentioned, a good time to maybe take a look at the assets that we have, how they're owned, who the beneficiary. I've seen it, and we've all seen it, that a person we named either passed away or I'm no longer married to are still being the beneficiary. We want to make sure that does not happen. We also want to, if you have an unfunded trust, make sure that, why is it unfunded? What do we need to be doing? Should it be funded? And if you have a will, making sure it's up to date, the people that you want to be the executor or successor on there, the guardians, etc. Just good time to look at all of that. And then what's going on with the changes in the tax laws, changes in your personal situation, the economic situation, just a good time to review and make some adjustments as we need. So let's I know there was a couple questions that we had. Jerett, I think I'm going to throw this first one to you.
Sure.
So if the owner and beneficiary of my U.S. savings bonds predeceases me, how can those securities be included in my trust?
Yeah, that's a good question. So, U.S. savings bonds, one of those things, someone passes away and you find hopefully a stack of them in a safety deposit box at the bank, or maybe even the sock drawer. There's an owner of a savings bond. There's a beneficiary typically listed, sometimes not. But if the beneficiary predeceases you, how do you get the savings bond into the trust? Well, our recommendation would be to, if you have a trust, you can do one of two things. You can change the registration of the ownership into the name of the trust, or you can change the beneficiary to the trust. So it won't matter who predeceases who. Changing a beneficiary designation or ownership for a U.S. savings bond can be accomplished online. It's no longer done through banks. As a recovering banker, I know this. The U.S. savings bond website is treasurydirect.gov. That's treasurydirect.gov. That's a very good question. Hopefully that helps you. And Jeff, I noticed I don't see any questions on here. I'm not sure if we did such a good job. There's no questions. or something's not right with the question and answer. I noticed someone raised their hand twice, so hopefully our Q&A is working. Nonetheless, we're always available for follow-up, so you know how to reach us.
Yeah, thanks, Jerett. Certainly, again, if we haven't answered your question, certainly reach out. 704-987-3410 is the office number here, or 800-738-6734. You could also go to our website and submit any questions. Ashley will send that over to us. Certainly reach out to your advisor if you have any questions more detailed. Again, this was not to be for you specifically. This was kind of just to give you some general ideas of things you should be looking for. In-person Zoom meetings, in face-to-face, when we're back face-to-face again, hopefully in the near term, we can all address these issues. Also, make sure, continue to tune in. Tomorrow, we'll have our Wednesday call, just a weekly update. Cliff and I will hold that call. We'll also assume we're going to have Dr. David Jacobs, who's head of trauma and emergency surgery at Atrium Health downtown in Charlotte, will be joining us, assuming his schedule does not change. But David has been gracious enough to be able to join us tomorrow. Look forward to that. And then we have some upcoming series coming on as well. So we appreciate you listening in. Appreciate your time today. Let us know what we can do if there's any other topics you'd like for us to address. We hope you stay healthy, safe, and we'll look forward to seeing you soon. Have a great day, everybody.